Chapter 4 deals with interest rates in a little more detail, basically kind of getting into how interest rates change and increase over time or increasing compared to other types of investments that you could have. So the first thing it talks about is that there can be default risks. So say you're investing in the bond market and there's 4 different companies you could choose from. Each one of those 4 companies could have different rates that they're paying on those bonds based on that default risk. So the default risk is the risk that that borrower will not be able to pay the interest payments as required, and then the amount that's due at the end of the bond, and the amount that's due as promised. And so, that getting into what that entails is kind of the credit risk of that company. What will they be able to pay that back? And then the textbook calls it a default risk premium. So the difference between kind of just what the general risk-free rate of the market is, if it's like 2% that you could earn on a savings account or a government bond, how much more are you earning on those bond interests? That how much more is basically what that default risk premium is, that you're going to get paid a little bit more because you're taking on a little bit more risk. The higher the risk, the higher that default risk premium would be, and then the more money you should make in interest on that calculation. And then there can be different things that impact that. I mean, you're never really able to completely know what type of company. You can look at their ratings. All corporations, their bonds would be rated like a AAA is the best and a CC is a lower rated bond. So, I mean, there's different ones in between there too. So you could look at that, but again, there's no crystal ball to say which ones are risky and which ones are not. And again, it could be things that happen within the firm of the company, like within their control. Maybe they make a bad business decision and that ends up impacting their net income. Or it could be that they overspend. Maybe they start producing more than they need to, and all of a sudden they're having some operational and sales problems. Or it could be things out of their control, changes in the economy. You can have something horrible happen, like a tornado or a fire or something like that. So all those things could impact the credit risk of that company. Then the textbook talks about inflation. Inflation can also impact the interest rates that we're seeing in bonds and in other types of investments. So the thing with inflation is that the prices are going to go up over time, and it talks about that that inflation can impact lower income people much harder than it will like wealthier people. So you figure your lower income and your middle class people, we're living off of our paychecks. So whatever we're collecting every other Friday, that's what we use to pay our mortgages, pay our groceries, pay our gas, pay our utilities. The wealthy people are living off of their investments. So they may have tons of money in the stock market. They may have tons of money in real estate, and they aren't necessarily just living off of their paycheck every other Friday. So it says that when inflation hits, normally the lower income middle class people who are working from paycheck to paycheck are hit the hardest because those paychecks are not buying what they used to buy. So then their gross spending is gonna be impacted. Whereas the higher income people, the people who are living off their investments, sometimes like real estate in an inflationary time, the real estate market, the prices actually go higher than even the inflation does, or they're increasing at a higher rate than the inflation is. And then sometimes even in their stock investments in a time of inflation, those values might start to go higher and higher, even at a higher rate than inflation is. So they may even actually have more money in an inflationary time period. So inflation can impact us and impact those rates as well. And then again, it kind of explains kind of how that happens though. But if you borrow money today and so you're a corporation, you're borrowing money and you're going to pay it back in 10 years, you borrowed $100,000, you're paying that $100,000 back in 10 years. Well, in 10 years, that 100,000, if it's in an inflationary period, isn't going to be as much as it is today. You know what I mean? Because the value of that dollar is decreasing. So then that is what you would like. Now, granted, you're paying those interest payments over the time frame, but still that change in the dollar kind of impacts that. Then it gets into calculating these real versus nominal rates when you're factoring in inflation. So the real rate is what you're actually like earning on that investment, and then the nominal rate is going to include the inflation. So it gives you some formulas, and it talks about like the ex post rate. So the post is going to be like after, if you're thinking of how words are, and then the ante would be before. So that the post is going to be after we actually determine the real rate of inflation, where the ante would be we're estimating what that rate of inflation will be. So we don't really know it. It hasn't happened yet. We're before that point. And then sometimes just those changes in those estimates can impact your investment. You may make a decision thinking, well, I think the inflation rate's going to do this, or the economy's estimating the inflation rate's going to do this, and then it doesn't. And then your investment doesn't pan out quite as good as you were hoping for. Then the next section talks about taxes. And then this is also an important thing to consider in your investment, and it can definitely impact the rates that bonds pay. So if you're investing in bonds or if you're the corporation and you're issuing bonds, the interest either that the investor receives is taxable to them, or the interest that the company pays, it's a tax deductible expense for them. So interest is part of our tax computations. So if you're the investor, then you have to know, okay, I'm gonna have to pay interest on this income that I'm receiving from these bonds, and that's going to effectively reduce how much you're earning. So then what the textbook is doing is they're kind of taking it after tax. So say if your tax rate, state and federal estimated tax rate's 30%, and you're making 5% on that investment, you're going to multiply that 5% times 70%, because it's 100% what you're making minus your 30% tax rate. So in a sense, you're netting that 70%. And then that's your true interest that you're earning. Then the next thing takes you in, and it talks about, well, there is municipal bonds, or they call them muni bonds. So those municipal bonds are issued by state and local governments, and they cover schools, and they cover roads, and they cover a variety of different things. Like we at Stark State, we were part of a bond for the state of Ohio to build one of our buildings at our school. It was just a 5-year bond, I think, so it's paid off now. But that's an example. So states can form together with their schools or with colleges and universities, state schools, and kind of do some of those buildings, some of those additions, change highways, do all that kind of stuff. And then obviously that takes money. So they too can issue bonds. And then the reason investors may prefer a state or city bond is because it is not taxable. So then the interest that you're earning on that is not taxable on your federal tax return. So they could even pay you a little lower rate of interest, because again, you're still saving that 30%, or you don't have to take it net of tax and multiply it by the 70% like I was just given the example of. And then there's some, it discusses like there's pros and cons against that. But I feel like, those municipal bonds are covering schools and hospitals and roads and bridges and highways and stuff that we need. I think it'd be in the best interest to keep those non-taxable, to keep the incentive there for people to invest in them. Because if you took that away, ultimately, I feel like our local communities would suffer. So it talks a little bit about that in the textbook. You could read that over. Then the next section of the chapter talks about the yield curves. So that kind of gets into the economics of it. And they give you some different examples of kind of if the yield is going up, if the yield is going down, if it's a flat yield, and kind of what impacts that. So basically, kind of what they're saying is that normally with the interest rates, our yield curves are upward sloping, meaning that we tend to think that interest rates are going to be increasing over time. Then it talks a little bit about like, well, that's not really realistic because we know that they don't always increase. I mean, sometimes they go down. So then, there's these different theories that can kind of get into that. Maybe why some of those things happen. And then it talks too that you can just have a shift in the whole curve. So the curve may be still slanting upwards, but it drops down or it moves up. So we have these three different theories, though, the pure expectation theories, and that is just basically saying that long-term interest rates are based on the expectation of what short-term interest rates will do in the future. And then again, it gives you some examples then and shows you again graphically, like if we see that it's an upward sloping one, let me see here. If we think that it is an upward sloping one, then that tells us that the short-term rates are going to be higher in the future than what they currently are. If it's the flat yield curve, then that's just basically saying that interest rates in the future are going to be the same as what they are today. And then if it's inverted, if it's sloping downward, then that is saying that our short-term interest rates in the future will be lower than what they are today. Okay, then it gets into the term premium theory. So then that's a second theory that kind of is saying it's going to impact these interest rates. And so what this one says is that longer term bonds have higher yield than shorter term bonds as a way of creating incentive for bond buyers to buy those long-term bonds. Because again, I think the underlying thought there is that maybe the investors don't want to be committed for 10 years. Maybe they really would only like a 2-year commitment versus a 10-year commitment. So the market has to give them incentive to say, hey, no, tie your money up for 10 years versus 2 years. So we're gonna pay you a little bit of a premium or a little bit more. So again, because it says like short-term bonds are obviously more liquid, you can get your money out of those quicker, and they don't fluctuate quite. The prices of them don't fluctuate quite as much as long-term bonds, again, because there's only like maybe a 2-year time frame. So again, they feel like that would be then providing the incentive for these bond buyers to buy those long-term bonds and make those a little bit more desirable, which would push that yield curve up. Then there's another theory that says the segmented market theory. It says there's actually just two different markets, that the people who invest in short-term bonds are totally different investors than the people who are investing in long-term bonds. So that, it's not, there's no incentive there. You're either going to be a short-term investor or a long-term investor, and you're not going to kind of switch those up based on the rates. And that, to some extent, that's true, because a long-term bond investor is somebody like an insurance company or a pension plan, or if it's in your IRA, something where it's truly long-term savings. You don't want to cash it out in 2 years. You actually want it to go for that period of time. And then the reason you like bonds is because you get that steady stream of income during that long-term investment time frame. So then it's just saying that those would be two totally different investors, and that the prices are not even, kind of linked to each other. Then our last section deals with our yield curve kind of applications. And again, it goes back and it applies if it was an inverted yield curve. So again, if it's going down, the different theories, what are they, kind of what do they say about that? So if it was an inverted yield curve where the long-term interest rates are going to be lower than our short-term interest rates, that pure expectation theory believes that the economy would be headed for a recession. It's going, it's going into a downturn. And then the segmented market theory would have that same conclusion, that the market's heading into a recession. If it was a steep upward climb where it is saying that our longer term rates are going to be well above these short-term rates, then the conclusion is either that there's estimating high inflation in the future, or that it's going to be a fast economic growth. We're going on an upward trend in our economy. Then that would be the pure expectation theories. The term premium theory would say that the savers have a better use for their funds, and they're worried about the future. So then that's what that theory would say. And then the segmented market theory would say again that that there's a expanding of a monetary policy where the government is getting involved and kind of shifting those rates to encourage or pick up the market, where that market interest rates are on the increase. Then we have the flat yield curve where nothing's changing. So basically all of those theories just say that everything is remaining the same. So the market's not increasing, inflation's not, going up very high, and everything's just kind of remaining same from the current to the long term, at least expectation wise. So that is our chapter 4 summary. All right, and I think that's it. Thank you.